I can only say that our distinguished keynote speaker has every credential for us to listen to you, sir. And sir, allow me welcome you to speak to us
in a short commercial break, and I assume in the next 2 or 3 minutes we should be able to resume with the discussion and have the other speakers
how the
do their
financial
thing. Thank
sector
you.
can thrive in the era of the fourth industrial revolution. So ladies and gentlemen, allow me now welcome our keynote speaker, Dr. Patrick Njoroge. Karibu sana.
Thank you very much for that very warm introduction. And Professor Emmanuel Tumusime Mutimbile, my brother, the governor of Bank of Uganda, Matthias Kantamber, the chairman of the Uganda Bankers Association, and of course the PS, outgoing PS of the Minister of ICT. I also applaud Uganda Bankers Association for organizing the conference with a timely theme, how the financial sector can thrive in the era of the fourth industrial revolution. And we are meeting virtually, but I recall Uganda's warm hospitality, beauty, vibrance. I'm optimistic that we shall soon be able to meet physically in the power of Africa, but also elsewhere. We convene at a critical juncture, firstly, having struggled globally with the ravages of the coronavirus pandemic for 1.5 years. Secondly, as was noted by the earlier speakers, we are at the cusp of the fourth industrial revolution, whose transformative powers are already evident in the financial sector, and will transform the way we live, work, and relate to one another. In the words of Professor Klaus Schwab, who actually popularized this label, I quote, "It is characterized by a fusion of technologies that is blurring the lines between physical, digital, and biological spheres," end quote. So both these elements portend stormy times for our way of life, society, families, and the institutions that we represent. But how should we react? We can attempt to stand firm, unyielding against these perils, and fully aware that they may destroy us. Or we can accommodate some of the pressures with the grace of a palm tree and build back better. So bend, but don't break. Allow me to set the stage by highlighting 3 disruptive trends in the current global context. First, the entrenchment of globalization. This is a product of the third industrial revolution and has redefined the terrain of governments, businesses, and citizens, shortening distances and brought together disparate people in common markets. Global supply chains have overhauled the traditional manufacturing and production processes with resultant efficiency gains. Markets have increasingly opened up, allowing businesses to expand their global footprints. The absence of a navigable route to the sea for Uganda, for instance, and other landlocked countries need no longer be a handicap to economic development. Closer home, regional integration efforts, particularly the East African community, have borne fruits with banks extending their reach across the region. The imminent operationalization of the African Continental Free Trade Area is expected to create an Africa-wide market with the resultant benefits from economies of scale. Financial markets have increasingly become global. In particular, the US financial markets have become a global bellwether with an outsized influence, including in emerging and developing countries. Given the dominance of the US dollar as a global reserve currency, we in the EAC are not immune to the dynamics in the US financial markets. Global movements in the dollar exchange rate and interest rates are increasingly impacting our markets. On the one hand, as we expand our presence in the international Eurobond markets, we are becoming increasingly vulnerable to movements in global bond yield curves. On the other hand, with the growing influence of foreign investors in our markets, we have to be alive to their short-term horizons and their potential flight to safety in turbulent times. Nevertheless, there are other urgent concerns that must be recognized and attended to. The cost of globalization in terms of the industries that are wiped out and livelihoods that are altered must be addressed. We have also seen the rise of nationalism in the last few years, particularly in Britain, Europe, and the United States, threatening to reverse the gains made by globalization. There has been an increase in retreat to protectionism as large segments of the populace, particularly in the West, feel excluded from the global economy. The COVID-19 pandemic has presented the two sides of the coin in this issue. On one side, the vaccine nationalism, particularly by Western countries, has shown the ugly face of the retreat from globalization. On the other side of the coin, the pandemic has emphasized the need for global cooperation and coordination, as no one is safe until we are all safe. We are certainly trending dangerous ground. Second trend is the proliferation of innovations and new technologies. From mobile banking to cloud computing, artificial intelligence to blockchain technology, Internet of Things and robotics, all heralding significant opportunities to re-engineer the operations of governments and businesses and transform lives and livelihoods. Even before the pandemic, digitalization had transformed the African financial sector landscape. In Kenya, we had seen access to financial services triple from 26% of adults in 2006 to 83% in 2019. These transformational financial inclusion stories riding on digitalization were replicated across the continent, including in Uganda, Tanzania, Rwanda, Ghana, etc. Undoubtedly, digitalization has been the silver lining during this pandemic. With various containment measures, including social distancing, lockdowns, and stay-at-home protocols, digitalization has enabled access to not just financial services, but also other essential services, including health and education. E-commerce has exploded as businesses pivoted to the digital marketplace. Businesses in diverse sectors ranging from hotels, retail, transport, communication, entertainment, health to education have to a large extent transformed their businesses riding on digital rails and platforms. Workplaces have changed with a shift to working from home on a scale that was unimaginable before the pandemic. Additionally, technologies and innovations are being adopted rapidly. New ideas and products are spreading at an exponential pace, putting pressure on innovators and promoters to compromise on the quality of their products. The third trend is the rise of sustainability concerns. It is now widely appreciated that businesses can only be as successful as the societies they operate in and draw their existence from. Environmental, social, and governance, ESG, considerations are now paramount in any organization's strategy and operations. Most notably, the adverse impact of climate change has become evident. Natural disasters associated previously with developing countries have spectacularly reared their ugly head in the developed countries. In the last few weeks, once-in-a-millennium floods have ravaged Europe, while heat waves and bushfires have scorched the western parts of the United States. So in these circumstances, the urgency to meet targets to reduce greenhouse emissions under the Paris Climate Agreement have been amplified. Significant financing will be required as the world moves to mitigate and adopt climate change. Will banks rise to this challenge? The consequences of failure are dire to society and banks, specifically as they reared from the danger to their loan portfolios from extreme weather events. Further, banks may be left with stranded assets if they do not keep abreast with the transition to a net zero emissions global economy. So against this backdrop of the significant transformation foreshadowed by the three themes highlighted above, how will bankers bend without breaking in this environment? How will they guide their institutions to thrive and not just survive? I want to draw on an analogy from football, appropriately so in the wake of the recently concluded Euro 2020 tournament. For the first time in over 50 years, England was on the cusp of winning its first major global tournament. Unfortunately, the trophy did not come home, but went to Rome. As English fans absorbed their loss, they must have remembered their retired talisman, David Beckham, who could have very likely made the difference. In his heyday, Beckham had the knack of kicking the football and bending its flight past the wall of defenders and into the goal. Analogously, how will banks develop fit-for-purpose strategies and business models, bending their way around the obstacles that come up every day in their field of play? I note that this is one of the questions that the governor of Bank of Uganda also expressed and also raised in his remarks. Will the institutions bend? Thank you. Let me identify the walls we must navigate around in three areas. First, we must not forget that it is all about people. With ROEs, PE ratios, and the bottom line are easy clutches, people centricity must be at the heart of products, services, and operations of financial institutions. The needs of citizens globally have grown over the last 18 months as lives and livelihoods have been upended by the pandemic, which has adversely affected the implementation of the SDGs and threatened the vision of shared prosperity for all by 2030. Recent World Bank assessments indicate a reversal in the global fight against poverty following the pandemic. An estimated 130 million people could slip into extreme poverty by 2030 if concerted global action is not urgently taken. Closer home, the African Development Bank estimates that 30 million people in Africa slipped into extreme poverty in 2020, and a further 39 million could slide into extreme poverty in 2021. So micro, small, and medium-sized enterprises, women, and youth have borne the brunt of the pandemic. Supporting the recovery process, therefore, will be at the heart of banks that will thrive in the new age. Targeted financial services to MSMEs and other vulnerable groups, particularly women and the youth, will be imperative. This will need to be supplemented by Finance Plus, particularly in the form of business advisory services, as MSMEs pivot their business models to fit the new normal. Second is the innovation presents opportunities, but also risks. This again was flagged by the governor of the Bank of Uganda, and I think also the permanent secretary, the outgoing permanent secretary of the Ministry of ICT. But how do we maximize opportunities while minimizing risks? Emerging technologies, including artificial intelligence, is a gold mine in building credit profiles and enhancing access to financial services for segments of our populace with thin credit files and who lack collateral. For financial institutions saddled with moribund ICT legacy systems, the cloud presents an opportunity to upscale to the anytime, anywhere cutting-edge financial services platforms demanded by today's discerning customers. Even as we reap from innovation, we must remain alive to the risks. Recent devastating cyber attacks, including SolarWinds, Colonial Pipeline and Kaseya in the United States, all come to mind. Just a few days ago, there was also the attack, a cyber attack on the infrastructure, port and rail infrastructure in South Africa. In the region, we have also seen an upsurge in online scams, identity theft, and social engineering attacks. We must therefore reinforce our cyber defenses internally to neutralize the insider threat. Externally, as a financial sector, we must build a circle of trust, nationally and regionally and globally, to share information and coordinate our cyber responses. Third, strong governance should underpin the culture in banks. This goes beyond the classic tenets of an effective board, management, and staff with clear, defined responsibilities and accountability structures. Governance in the age of the fourth industrial revolution would also be about the public good. For instance, supporting appropriate behavior in the financial markets. Banks play a critical role in the foreign exchange market and are key players in the government securities markets. Misbehavior in these markets adversely affects society through distortions in foreign exchange rates and raising the cost of debt for government. Appropriate market conduct is therefore imperative to avoid short-term profitability gains jeopardizing the long-term societal good. Anti-money laundering and combating the financing of terrorism, AML-CFT, is another key facet of supporting the public good. Lapses in the AML-CFT can be devastating given the consequences, particularly of tourism. Kenya, for instance, has borne the brunt of terrorism, including the Dusit 2 complex attack in 2019 that took advantage of vulnerabilities in AML-CFT framework of part of the financial sector. Technology now offers banks cutting-edge technologies. Technology now offers banks cutting-edge technologies to monitor and analyze transactions and reinforce their AML-CFT defenses. Colleagues, as I draw to a close, I want to emphasize that we must all act with courage to do the right thing and not just survive, but thrive. We must have the courage to bend it like Beckham, to go around the walls to attain the goals of people centricity, balanced innovation, and stronger governance. I'm sure you will reach deep and find the courage to bend it like Beckham, one day after another. or as we are in a marathon and not a sprint. Across the street from my office is a large mural of Kenya's marathon champion, Eliud Kipchoge, with his mantra, "No human is limited." Along with the millions of his fans, I'll be rooting for Kipchoge on August 8th as he defends his Olympic marathon gold title against other strong contenders, such as the Ugandan team led by Stephen Kiprotich. We may not agree on who is best placed to win the 2020 Olympic marathon, but I'm sure we will agree that in as much as no human is limited, the financial sector must and will find a way to bend without breaking in order to thrive in this new age. Thank you very much for your attention.
Dr. Patrick Njoroge, you have set the pace, you have set the momentum, but above all, the foundation that is critical for us to have a fruitful conversation this morning. I think you've touched on a number of things that we definitely need to reflect on quite deeply as a sector, but I also say as individuals, because the things that you've touched are one that really speak to the realities of the time that we are dealing with. So I want to thank you very much, Dr. Patrick Njoroge. And I'm pretty sure there may be one or two people in the audience, I mean those that are following us, that will have a few questions, and if you permit us, we will share those questions with you. And the assumption is that you will stay on a little bit for some time and we can share those questions with you. Let me now allow the team to play the video that introduces that talks about agency banking, and right after that I will have the first panel coming up with some of the speakers present and the other speakers virtually. So if you have one or two questions as we wait for the other panel to come up, we'll probably share those with Dr. Patrick Njoroge. But let me ask the team to play that video as probably some questions come through. Thank you. Thank you very much. I have one or two questions, Dr. Patrick Njoroge, if you're still on, that have come in from the people that are listening to you or that listen to your keynote. And so the question that has come in from a participant is around people and the institutions that we run with or work with. What advice would you give to an institution or a bank, because you have the whole range? And this question is, how can you have a bank at the base of the pyramid dealing with the people prepare for this revolution? Because like it or not, they are in the thick of the storm. Over to you, Dr. Patrick Njoroge.
Thank you very much for that question. Actually, I want to start by saying that I presume we all appreciate that we are not running NGOs. So all of us are running banks, commercial banks. So let's begin there. So how we relate to people is completely different from, say, how Mother Teresa or any other NGO out there. And by the way, I do respect and support all the work that is done by those very worthy persons and etc. The point here, though, is you have a bank whose objective has to be people. What do I mean by that? Let me ask you a question. It would be nice if this was an open forum where I can see all of you. The question is, if I could have asked the question, how many of you have, if you thought of your most complicated problem, the thing that keeps you up at night, as they say, what is it? And most of you to generally be technology, or problem with some shareholder, those sort of things, or problem with a large borrower, those are the sort of things that keep you up at night, I think. And that is really the problem. Or maybe you're coming up to an AGM and you're thinking about the ROEs or end of quarter, those sort of considerations. And therein lies the problem. It really should be your customers. And what are you doing to improve, let's say, the experience of your customers? You see, at the end of the day, if your customer is served right in terms of the products that are there, that the products actually are serving the customer, then that customer will be with you, and the rest will just fall into place, the ROEs, etc. And I think that is the issue. At times, for instance, and this is an issue also, I talked about this thing of technology, being pushed to do something. So all of you, I know, are under pressure to, quote unquote, perform, right? In terms of technology. So you want to be the first one to produce a particular app or a particular product that, IT product, etc. And I'm sure your people are pushing you as CEO to launch that product. So the question is, wait a second, how will it serve the customer? And as I say, at times you have products that are going out to the customer that are actually half-baked. They are not exactly ready for prime time. And no wonder they end up becoming easy to compromise in terms of cybersecurity, but also other things you find that they are not, the customers are not interested in that. So I think the issue for me is how connected are you with your customer? And do you really understand what is driving your customer and what are the concerns? As I say, for instance, now our issue has been how will we deal with SMEs? That is a problem that I don't think a lot of, let's say, advanced economy banks are concerned about. But from our perspective, Kenya runs on SMEs, and I'm sure Uganda the same. Africa runs on SMEs. So we need to reach out to that SME that doesn't have security. They don't have like a huge piece of land somewhere or title that they can actually put. So in a sense, we have to think, do the heavy lifting and thinking of how to work with that particular SME. So I think those are the considerations I would probably throw at you, and also indicate that it is a good problem. When you resolve it, you end up having very loyal customers, and that is what is going to develop you into the future. If you look at the banks that have actually succeeded in Kenya, and I guess in Kenya, because that's where I have very good idea of every single bank, right? The point is the ones that have succeeded have actually been close to the customers. Those that want to work on corporates, right? So the idea is, okay, we're just going to maintain our space in corporate space. They'll die like dinosaurs, So in a few years, we'll bury them, and, you can already see they have scales on their backs. So I don't know whose side of the fence you are on, but I don't want banks that are dinosaurs. I want, banks that can actually transform themselves like egos into something else fit for purpose. I'm sorry that has been a long answer, but I hope it has helped.
No, you've nailed it. I mean, what I'm picking from you, Dr. Njoroge, is don't think for the customer, bring the customer in and let them be part of the thinking process, which we call the co-creation process. So let them be part of the creation so that even that application that you're building needs to be a pain point, needs to be solving a pain point for that customer, and not just that because it looks very good for you as an entity. And I guess as we close this for the next session, the question of sector collaboration which has also come in from one of the people who are watching us. How do we collaborate without breaking our backs because we are competing?
Good question. I think there's a simple answer. There's a simple answer. The marathon. By the way, I'm very close. I can reveal it here. Eliud Kipchoge is a friend, and I have learned a lot from him. Not about running. I mean, he is miles above us in terms of running. But as a human being and approach to issues, I think he's the one who really should be talking to you, not me. Why? He makes the point. Marathon running is really, it looks like, it's an individual sport. You just put on your shoes and go out there and run. But actually he says no. And his point, and I quote, 99% of me is nothing compared to 1% of the team. So in his mind, marathon is a team sport. And when he trains, he's training with the others. He never trains on his own. And you can say the others are probably not as good as him or whatever. That's not the issue. And actually, I'm pretty sure Stephen Kiprotich could actually confirm that that is the case, because he also has been training in the same neighborhood in E10. So I think the point here is that we should really, let's say, dissuade ourselves from this old notion of competition, that, it's a zero-sum game, that if I go down, if I push you down, I'll go up. That sort of competition doesn't make sense. I mean, you just talked, and in the presentation just now, there was that product that was put forward by some of the Bank of Uganda and also some of the other collaborators, which actually allows a lot of transactions to take place across banks, etc. And this will be of benefit to the consumer. I mean, you cannot do that without collaboration. So I think there is a lot of scope for collaboration. It is true that we are also different, meaning at the end of the day, we are running the marathon. I'm running, you are running, but we work together in things that, in terms of pacing each other. And I think this is what we need to do. So let's learn from the elite runners or elite athletes, because really there's a lot of scope for collaboration in everything that we do.
Hello, thank you very much, Dr. Patrick Njoroge. I am pretty sure we could have gone on for even another 2 hours, because I think picking from what you've just shared around marathon running, I've had an opportunity to train for a marathon, and to be honest with you, I can relate that completing had nothing to do with me, but everybody else who was cheering on. Now, don't ask me what time I made in the marathon. The key thing is I did 42 kilometers, and it was in Nairobi. So thank you very much. Truly humbled, and it's our pleasure to have hosted you as our keynote speaker. Like I said, you've set the tone, you've set the pace, but above all, the foundation upon which we are going to have the next conversations of the day. So we'll allow you to take on and maybe possibly listen to the other sessions. Asante sana, and we truly, truly appreciate your time with us this morning, Dr. Patrick Njoroge. Thank you very much.
Thank you very much. Have a good conference.
Thank you, thank you. We're going to take a 5-minute break and allow us to go to the different breakout rooms, check out the exhibition as we get the next panel up. And the next panel is going to have a deeper conversation, largely following on to what has come out of the keynote address, but also the different presentations that we've had this morning. and my colleague Julie Kugonzibwa is going to lead that session, and they're going to be discussing tracking developments in the payment space, emerging trends, and the future outlook. And so in 5 minutes, and that is at exactly 10:52, we will be getting back with that panel running. Thank you very much, and please don't go away. Thank you.
And our discussion is a follow-through on what has been discussed since yesterday, but specifically focusing on payments and the trends of payments and what opportunities that places for the industry and all the players. This morning, I have the pleasure to host panelists from industry and regulatory spaces. I'd like to begin by welcoming Ms. Anne Juko. She is here physically with us. Welcome, Anne. Anne is the, sorry, just come on, please. Anne Juko is the current Chief Executive for Stanbic Bank Uganda. Welcome, Anne. She brings a wealth of experience in the financial industry, both at the corporate level, but as well as serving on the individuals in the economy. Welcome, Anne, and we believe you'll have an opportunity to tell us more about Stanbic Bank. The next panelist with me here is the Executive Director, Supervision from Bank of Uganda. Welcome, Dr. Twinamanzi. Welcome. Dr. Twinamanzi is a Ugandan economist and central banker who currently is the Executive Director of the Bank Supervision Directorate at the Bank of Uganda, which is the country's central bank and national banking regulator. Prior to his appointment, he served as the Director of Industry Affairs and Content and Economic Affairs at the Uganda Communications Commission. Welcome, Dr. Twinamanzi. I have the other panelists online. We also have Ali Sheira, Mr. Ali Sheira, the Country Manager, East Africa for MasterCard. Welcome, Ali.
Thank you.
You're welcome. Mr. Sheira Ali is the current manager, East Africa MasterCard, and seasoned banker with enormous experience in international payments, portfolio management and card payment systems. Sheira will be telling us more about his role and what his entity does. Our fourth panelist this morning is Mr. Peter Kaumi, who is the board chairman of the Financial Technology Services Providers Association, FITSPA, and also is the current country general manager, Interswitch. Peter, you're welcome. We have Peter online as well.
Thank you very much, Julie. A very good morning to each and everyone here.
Good morning. Welcome, Peter. Thank you very much for making the time and also for the discussion that we are going to have that very well connects with the earlier speakers, especially on focusing on the customer. Payments is one of those financial services that has a unique ecosystem that looks at the merchants as well as the buyers or the payers. So I believe this discussion will be is very exciting. And one of the key elements that comes with the fourth industrial revolution is where we see the progression of banking into a platform business. And the key offering service, one of those is payments, as I've shared. And that's what will be the focus of our discussion this morning, to look at the developments, the emerging trends, the opportunities, and how we can leverage those as industry. So as we get into that, I'll ask that each of the panelists will give us a 1-minute introduction of what they do in the industry. And Anne, you may want to give us that for purposes of the international audience.
Shall I start?
Yes, please.
Okay, good morning, everyone. My name is Anne Juko. I work for Stanbic Bank Uganda. I have been a banker over 20 years, and I'm really, really pleased to be here. Thank you.
You're welcome. Yes.
Good morning. My name is Twinemanzi Tumbeni. I'm the Executive Director Supervision. I'm glad that the Bank of Uganda, my job basically involves providing oversight over commercial banking, non-bank financial institutions, and I'm also responsible for financial stability in the banking sector.
Thank you very much. Thank you. Peter, you'll tell us about FITSPA and yes, Ali, please go ahead. Sorry. Ali, please go ahead and share us about MasterCard.
Good morning, everybody. Thank you very much, Julie, for this opportunity. So my name is Shehryar Ali. I am the country manager for MasterCard for the East Africa region, covering 13 geographies, and Uganda is a prized geography for me. And I'm really looking forward to getting into this very engaging discussion and the topics that we have on hand. Thank you very much.
Thank you very much. Thank you. Yes, Peter, please go ahead and talk to us about FITSPA.
Thank you. Thank you very much, Julie. Just confirm you can hear me.
Very clear.
Thank you. Thank you. A very good morning once again. My name is Peter Kaumi. I am currently the chair of the Financial Technology Services Providers Association in Uganda. In short, we call ourselves the FinTech Association of Uganda. FITSPA represents the local and global FinTech companies that are operating in the country. And our operations are centered around 3 pillars, which is community. So we bring together diverse parts of the FinTech ecosystem to dialogue and collaborate about different things that are going on within the market. Innovation, so we learn from one another to address the pain points faced by the African communities in which we serve. And policy advocacy, so we create a unified voice for the FinTech ecosystem to engage varied stakeholders in policy, on regulation, and other issues. We work very closely with the Bankers Association, so we like to think of the UBA as our big brother and have partnered with them on various things. Today we are a membership of close to 160 members doing a wide variety of things. From your little brother, FITSPA, to UBA, each of our members thanks you for inviting us to contribute to this conversation today. Thank you.
Thank you very much, Peter. And we'll get into the discussion. Dr. Twinemanzi, I'll ask that you kick us off this discussion, specifically looking at how regulators, specifically the Bank of Uganda, will continuously adopt on this changing environment and platform for enabling payments in Uganda? Thank you.
Thank you. As I begin, perhaps I'll start by paraphrasing Charles Darwin in his landmark text, The Origin of the Species. He said, and I quote, "It's not the strongest species that survive, nor the most intelligent, but the ones most responsive to change." And the evidence on that to date is that the faster the change, especially driven by technology, and whether in the payment space or in any other sphere within the financial services, the consequences of not adapting are far much greater than the costs associated with adapting. So to your question, how should or must we as regulators adapt to this new fast-changing environment? There are three things I would like to start with. One, as regulators, we have to acknowledge, accept rather painfully, that technology will always run much faster and further ahead than regulation. That's the first admission. Second, as regulators, we should not be tempted and we should be averse to attempting to regulate technology, but rather focus our regulatory and supervisory activities and policies to the products and services that those technologies provide. Third, and by focusing on the products and services, it means that our questions as regulators and our concerns will be rather limited to, one, ensuring that for whatever the technology is, irrespective of the technology, platform independent, whatever the product or the service, our focus as regulators should be on how comprehensively identified are the risks associated with those products and services. Two, how effective or the efficacy of the risk management mechanisms that either the providers or that we put in place to ensure that those risks are mitigated. Because for risks, you have got two kinds of risks. You've got what we call diversifiable risks and non-diversifiable risks. Diversifiable risks are those you can potentially pay someone else to take on because they're in a better position and have better skill set to handle those risks. Non-diversifiable risks are those that you must internally find a way of managing so that you minimize the impact, especially the negative impact, but maximize the upside of those risks to your business. And then third, especially from financial institutions, is in the event, however, because you see, however comprehensive you identify the risks, however good or effective the risk mitigation measures you put in place, sometimes you have black swans. You have events that, to use the words of Donald Rumsfeld, the unknown unknowns. In the event those risks were to materialize, to what extent or what amount of capital or reserves are you holding to minimize the impact of those risks on your balance sheet? So, in my humble opinion, really, that's the best way we as regulators should respond to this ever-changing landscape around the business models of those we regulate. Thank you.
Doctor, thank you for that detailed baseline that you give us on how regulation is responding, and really it gives us the opportunity to see that the industry is under cover and clearly being regulated. Now, there's an element that you raised, Doctor, about the fact that technology moves faster than the supervision or the regulation, which I believe is in many ways an opportunity for the financial sector in areas of innovation. And that brings me to Ali, please, that if you could speak to us about the role of development partners like yourselves in the area of innovation to be able to see how these emerging trends in the payment sector, how you come in to support the financial services industry to see that there is growth in that area. Welcome, Ali.
Thank you, Juliet. And thank you for asking this pertinent question. You know, we think about these things day in, day out these days, and the trends are changing so fast that it's sometimes hard to keep up. But firstly, it's a pleasure to be sharing this panel with Dr. Twine, who is my fellow Longhorn from University of Texas, Miss Anne, a pleasure as well, and Mr. Peter as well. Well, you know, COVID-19 as a pandemic, you know, has had its economic implications and has kind of left the world reeling in its wake. Now, in the weeks and months following the outbreak, a new ecosystem has taken over the old one. You know, there's a cause, it has caused a departure from the traditional ways of how people worked, how they shopped, how they live. And if I just step back and think of the pandemic, it has had an adverse impact on various global economies and people, but in many ways, it has been a catalyst for change. Exponentially, I think more people are now aware and understand that the cost of cash is pretty high. There's the cost, actually the physical cost, but then there is the health and safety related issues as well that have come to light. So I think what the pandemic did for payments was that it changed consumer habits. 73% of people in Africa and Middle East are shopping more online than they did prior to the pandemic. And that's a huge number by all estimates. Our current estimate is that 20 to 30% of the COVID-related surge in e-commerce, it's going to remain because behaviors are sticky. So when behaviors are changed, yes, there's initial spike, but then it continues or it maintains that momentum. According to the MasterCard's new payment index survey, 95% of people in Kenya, Nigeria, and South Africa are considering emerging payments such as wearables, biometrics, digital wallets, cryptocurrency is also getting tested, and QR codes is becoming more of a norm. So in Q1 2021, MasterCard witnessed 1 billion, that's a huge number, 1 billion more contactless transactions globally compared to Q1 2020. So the three trends that I see on the payment side, Juliet, are that firstly, e-commerce has gone up a lot. But more importantly, it's not just that it scaled during the pandemic because you're sitting at home and you still need to shop. It is now that consumers have tried it and are comfortable with how it's supposed to work. And as we go forward in the future, it will be a channel that consumers will use more often than they have ever done in the past. The second thing is contactless. When one suddenly starts to think that physical contact has issues with it, both in terms of the customer experience and then cash, which itself comes with its own set of issues, that's something that people are reacting to now. And the third trend that we are seeing is domestic spend is going up, which if we look at the numbers, it's grown up by 38% in Africa and the Middle East in Q1 2021, year on year. But, you know, I think, like Mr. Twine also pointed to the fact that every change comes with its own set of challenges that we all as stakeholders in our ecosystem have to deal with. So the rise in the online transactions and digital payments has been accompanied by a surge in threat actors who have exploited uncertainty and global events to perpetuate malicious acts. According to the McAfee report, with global spending on cybersecurity expected to have exceeded $145 billion in 2020, cybercrime is now a $1 trillion drag on the global economy. And that's massive. And that needs a reaction. And Africa is no exception to it. So to mitigate cyber threats, MasterCard has launched several initiatives. In 2020, it unveiled the CyberSecure, an AI or artificial intelligence powered suite of tools enabling banks to assess cyber risks. And in 2019, the same company protected stakeholders from $20 billion worth of fraud. So that's just one example. But let me come to the more interesting part, Juliet, which I think the panel will probably discuss in further detail. Data security, privacy, and safety is becoming a critical challenge of the hour. And why I say that is that because we, as the leaders of our ecosystems, must preserve certain customer rights. Now, what are those rights? Firstly, it's your data as a consumer, and you have the right to benefit from it. Second, you have the right to know who has been collecting your data, and you should not be subject to 18-page complicated disclosures to understand that you are forfeiting those rights. Thirdly, you have the right to be forgotten. You should have the power to remove your data from entities that you don't want to hold the same information. And fourthly, we as responsible players or stakeholders in the ecosystem, when we do collect data from customers, we must ensure and strive that we collect only the minimum data that is needed to conduct or provide a particular benefit to the customer. So I believe the democratization of digital payments will yield results if we re-engineer solutions to cover all socioeconomic segments and don't leave anybody excluded. We must lower the digital costs. We must regulate taxation in a way that it promotes inclusion versus exclusion. And I think we must fight the menace of cash. And that's something that the new trends that we have just touched on is rapidly replacing. Although under no delusion, 90% of all transactions today in Africa happen on cash, but this trend is changing. Thank you, Juliet.
Thank you very much, Ali, for that detailed trend analysis, both from the customer's need as well as the offerings that are available, but also being able to put that together with the areas that we need to look at. I really want to bring that to life by asking Anne to share with us what financial institutions are doing to using the fourth industrial revolution to harness financial services, payments, and as well as being able to continue doing the role of financial institutions, creating that safety, that trust in the industry. Welcome, Anne.
Thank you. Thank you very much for that question. I think to put it in context and to put it right, I'm not copying Dr. Twinemanzi, but I think if I was to copy somebody, it would be a bad one to copy. But I'll put it in context by starting to quote the founder and executive chairman of the World Economic Forum, described the fourth industrial revolution as that there has never been a greater time, a time of greater promise or peril, and than what the fourth industrial revolution represents for all of us. The fourth industrial revolution is something that is going to change every single facet of life. In fact, it's already changing it. The question then becomes, how do we, in the financial sector, use the new technologies to perform our intermediation role better? How do we move from what we've always had into something completely new? And if we were to be honest with ourselves, we would start by acknowledging that we haven't always, in fact, we are yet to do our intermediation role the way we should do it. And the reason why I say this is, one, we haven't included everybody. The question of the issue of financial inclusion continues to be a sore point everywhere, and something that has to be addressed. And these new emerging technologies will be able to help us do that. The issue of cost of banking I can see the regulator nodding. The cost of intermediation is another big one. So when you think about the Industrial Revolution and the advantages it gives you, or what it promises to give us, questions of being able to provide affordable banking to everybody, and I mean everybody, leaving nobody behind. And I suppose if you listen to Dr. Njoroge before, he emphasized a lot about inclusion. It is the challenge of our generation. And I cannot think of a better way to get inclusion than to use the new technologies. And we also talk about the peril of the fourth industrial revolution. One of the biggest things I concern myself with is what it actually means when all these technologies come to life. Yes, we will do our jobs better, we will serve Uganda better, and indeed, in the long run, we should be able to lift the economy as a whole. But it comes with some challenges. And some of those challenges that Mr. Schwab talks about is the human cost. The human cost. And I don't want to go far. I'll give you an example we can all relate to. If you take banking 20 years ago and you walked into any bank, there would be members of your staff who had been tellers for 30 years. It was a profession. You were a teller. And it was a paying profession. You looked after your family. You did well. But today, if you look at any bank volume, the volume of transactions coming through your branches is reducing every day. So what happens to that human resource? What happens to that? Where do we put those people? How do you change them into something else? So the fourth industrial revolution, yes, will open, and we have to be discussing these things here, that yes, it will provide a lot of promise and a lot of ways to do things better, but it comes with the challenges, and we must be cognizant of the challenges and seek solutions to those challenges. The human one is just one of them. There are several others. I understand that the issue of cybersecurity will be talked about over and over again. It is a clear and present danger that we need to talk about. The issue of capacity and how we change the way the human resource impacts. Yes, we want to do all these things, because when you talk about fourth industrial revolution, you're talking about self-driving cars, 3D printing, deep learning, AI, and all that. But who's going to do these jobs? Where is the capacity to get these things done? If you look at the university intake and the university outputs, they are still training more MBAs. And they are still training more accounting. They are still so they are training more of those, and where the industry is actually moving. Yeah. So even as we embrace these technologies, which will surely change the way we work, we must think about the perils. So it's a promise and a peril. The perils and how we handle the perils. But no doubt, move forward we must, knowing full well what the challenges are and how we unlock these challenges.
Thank you very much, Anne. And that is very insightful, looking at how the emphasis that came through from the keynote speech about human-centered, making sure that we center our services and offerings to the people. It's very interesting. And we've seen that there's new operating models that have come up and business models that have come up where we see entities that are usually called startups, but I want to look at them as fintechs, because whether they are startups, but they are fintechs, so that we have to kind of work. They bring along an entrepreneurial element to pick up the gap that is presented by the human capital issues, as very well highlighted as one of the issues. So I'll ask Peter that you speak to us about what that layer of fintechs can do to support the growth of the economic growth, but specifically also to complete the payments ecosystem. Welcome, Peter.
Okay, thank you very much, Juliet. And but first of all, I will start by saying it's extremely exciting to hear a big bank like Stanbic, to hear the regulator really recognize the role of the fourth industrial revolution, to recognize the role of fintechs and the role of technology as a whole in changing how financial services are consumed. It's exciting for me, for somebody like me who is in fintech, because it is evident that financial technology and how consumers are adopting financial services has changed over the last few years. I mean, we've moved over the last 20 years from checks, from EFT and RTGS to instant payments through mobile money, to instant payments through various apps, to agent assistant transactions through third parties, through bank agents, etc. And this is very exciting for the economy. It's very exciting for financial sector players, etc. Importantly though, even if we've seen these developments over the last few years, it's important to note that we are still barely scratching the surface. There are still very many Ugandans that are not accessing formal financial services and therefore do not have access to trusted savings, to trusted credit facilities, and to trusted payments solutions. And the knock-on effect of this is that the economy as a whole is affected. Now, somebody might sit back and say, government at Yambe, what can the government do for us to address this? But the reality is that we as a financial sector industry and financial sector players have a much even bigger role to play. Now, what I would like to do is to highlight 3 areas that I believe directly within the payments ecosystem, financial sector players can actually work together to address. And what I will do is give very live examples about what's going on today and the work that FITSPA is doing in collaboration with the Bankers Association. The first is an area that Anne has touched on and is clearly on her mind and maybe keeping her awake. And I know is an area that that you're very passionate about, Juliet, and also Michael is passionate about. And this is an area of talent and job creation. Today, there is a major net skills demand in the payment space and in the financial sector for the future. What do I mean here? What I mean is that the universities, the colleges are not churning out near enough talent for absorption into the financial sector and into the financial technology space. So earlier in his presentation, Honorable Bajiri spoke about, there not being enough cloud engineers, there not being enough EFT engineers, data analysts, etc. By the way, in the past, I've been accused of using very many acronyms when I'm speaking to audiences. But this time, I'm actually doing it on purpose because I would like to drive the point home. Today, we don't have enough skilled people in these technologies that we know are driving the future of the financial sector. And the result of that is that when a bank or another financial sector player wants a chief innovation officer, or if they want a switch administrator, or if they want a data analyst, what they end up doing is stealing from another bank or stealing from another sector player within the fintech space. What we need to do is think very creatively about how we plug this gap. FITSPA is working collaboratively with the Bankers Association through the Uganda Institute of Banking and Financial Services to get ahead of this. And what we're doing is working very closely with the Institute to develop a curriculum that addresses the gaps that we see in the industry. Secondly, so that is talent. Secondly is on product development. As I mentioned earlier, and has been mentioned by Ali during his earlier presentation, is very many people are still not within the formal financial sector. What that means is that the products that are being developed by banks and other sector players may not be responsive to the consumers. And yet we know that there is an increasing interest in African consumers, which is why we see all these international financial service providers coming onto the continent to try to serve these consumers. Now, what that means is that there is high demand for insights that will be driven by understanding what the data tells us about these financial service providers. So I'll give an example. Today, we have some members within our association that have merchants, that have agents, that have been serving consumers over the last few years. These small businesses often do not have a bank account and have no interest at this time in opening one. And yet, these members, these network providers have a lot of data relating to these small businesses. It would be very, very exciting if we saw collaboration between some of the Bankers Association members and FITSPA's members to address the needs of these small businesses. And going back to the earlier point that was made about SMEs, SMEs are the driver of Uganda. And we have here an opportunity of up to 50,000 small businesses that need credit today, particularly now during COVID, where their capital has been eroded on the back of the pandemic. Lastly, and very briefly, I would like to talk to international trade and remittances. A couple of weeks ago, I was reading a report from RemitScope, I think, that said that Uganda, remittances into Uganda last year were at $1.1 billion. So $1.1 billion came into Uganda in form of remittances. And these are people who are doing cheyo, working in other countries and sending money to home for consumption. However, the cost of those remittances coming into Uganda was 11% averagely. This is higher than the Africa average of 7.5%, and also higher than the East Africa average of 8.4%. What this means is things like East African Community, COMESA, the Africa Continental Free Trade Zone. These things don't mean anything to the person of every day. You know, these things need to really be brought to life. A fair way of looking at it is also related to the cost of delivering financial services, as Anne mentioned. We have to think creatively about sharing the infrastructure that drives the cost of the delivery of these financial services higher. These may be through shared masks, that as we've seen in telcos, but also through shared infrastructure like switches, etc. Thank you very much, Julie.
Thank you very much, Peter, for putting the payments ecosystem to life and really bringing in the element of risk that is presented. And that's what brings me back to you, Dr. Twinamanzi. You highlighted earlier that one of the key roles of the regulator is to see the effectiveness of the risk management framework, both within the regulator space, but of course by the players. Looking at what has been discussed on the gaps of people, skill gaps that comes with the fourth industrial revolution, but yet that gives an opportunity for partnerships with innovators like fintechs. That creates a whole new operating business model. So just giving us that, highlighting to us the way the risk management control that the regulator will continue to, that continues to give the industry to be able to create the trust, because this area needs to grow. I believe when the payment space grows and we pick up the different opportunities available, then the trust increases and the cost issues that have been highlighted and many other things would come down. So I welcome you, Doctor, to speak to us on that area of risk management, oversight by the regulator in working also with even other regulators in this space.
You know, normally before I speak, I say something, I like to preface my words with a quote from someone. There's a gentleman who is often referred to as the sage of Omaha, Warren Buffett. And his basic guiding philosophy, his investing philosophy is, it's inevitable that any business will make money, that any innovation has an upside. So his only one instruction, if you read through some of his letters to the shareholders, his one focus is, do not lose money. And that's from an investing point of view. Let me bring that home now to technology and risk management. As my friend Kaumi has said, fintechs, which is financial firms providing technology services, or tech fins, which are technology companies providing financial services, are always focused on the upside, the benefits. But I am yet to find one single human endeavor for which their only upsides, the only benefits, with no downside. None. And you can allow your mind to roll into the gutter and go as far as go down that road. But for every benefit, there is a downside. Isaac Newton said, for every force, there is an equal and opposite reaction. Now, as a regulator, and one that has moved and is in the process of moving completely entirely to risk-based management, what does that mean? It means that our job is largely more or less defined for us. That in as much as all these technologies are coming, and they're inevitable, we can't stop them. And to use a phrase from Ruchiga, toka yanga kuyama nguti nekurota, you cannot refuse to sleep because you fear nightmares. These things are inevitable. The question then becomes, is to what extent have you clearly identified the potential sources of instability either to your business model or risks to your business model? Governor Njoroge did make reference to this when he was talking about some of these products being brought to market before they are ready, so to speak. So on risk management, the focus is on how well have you identified both the existing risks and emerging risks that you see over the horizon coming by virtue of the fact that you've made a decision to adopt a specific technology or use a certain platform to deliver your services. Okay? Or to what extent have your existing risks, to what extent are they being modified or transformed, and how ready are you to deal with those events in the event they materialize? Go back to my earlier statement about diversifiable and non-diversifiable risks. So in assessing the risk management frameworks or mechanisms that institutions put in place as they adopt this technology, the first question is, we ask, do you understand the risk? Is it a risk you can pay someone, maybe perhaps pay an insurance company, and they take over? And you sit back and do what you have to do. If it's a risk that you have to take on, how ready are you both from a governance point of view, from an operational point of view, from an IT readiness point of view, in terms of skill sets and resources to handle or manage this risk? Because some risks can never go away completely. But you can ameliorate the impact of those risks. So in assessing risk management, that is our focus. To what extent do you have a system, structures, processes, technology, and people to minimize the impact of that risk on your business model and on those external stakeholders that depend on your continued existence for their sustenance? To what extent do you have those structures in place to manage that? This is always an interactive discussion, especially when it comes to 4IR. It has to be. Without intending to say so, it has become very clear in the discussion we had so far that even the central banks, as we are in the worst position when it comes to even understanding some of these technologies. Okay? We, as central banks, we tend to focus on what was being done in the past and make sure it does not happen again. We need to have a mindset change to say what could happen that has never happened before and how to prepare ourselves for it. If we understand that, then it becomes easier when it comes to the questions we ask the entities that we regulate. Okay? So that is a broad synopsis of the kind of what we look at when we talk about risk management for these fourth industrial revolution technologies. And by the way, just for the record, it is not so much that the fourth industrial revolution of 4IR is only applicable to the entities that we regulate. Even we ourselves must begin thinking of how we need to change the way we regulate or supervise, taking advantage of these very same technologies that the entities we regulate use. So, something I said earlier on, because remember I said technology will always outpace regulation. I think the bigger focus for us as a regulator is, yes, if we can admit that and accept it, which is inevitable, our focus then should be that it should not run too far ahead for us. So in other words, we've got to keep running and make sure that perhaps we can't be one step behind, but we should be too far behind, because then what's the point of regulating when you are attempting to do something that you don't understand, or that is constantly changing, that by the time you go through your lengthy process of putting in place laws, regulations, policies, and so on, they are already outdated. Thank you.
Thank you, Doctor, for that detailed framework of what you consider as a regulator. And I would like that you give us the context of what are those, because you shared with us the challenges that comes with the 4IR, but those challenges come with risks. So what are those risks that you're facing as industry, even as you continue to look at how you use 4IR as an inevitable way of progressing banking and offering financial services? Thanks.
Thank you for that question. There are several risks, and these come in different and varying categories. But I'll broadly characterize them. We already talked about cybersecurity. That is a really, really big risk. And it's a risk in a sense that it is almost unquantifiable, because you cannot mimic. It's not a function of what's happened in the past. So it's such a big part of what we need to do to get ahead of, if we can. And the numbers from earlier of 20 billion of worth of risk that they've saved is testimony to how big this industry is. So that's number one. But there are other conversations, and I'm glad the regulator is in the same room for us to talk about, that the market demands that we innovate and innovate quickly. Yeah, but the regulatory framework is not set up enough to allow for collaboration. And I'll give you a simple example I had this morning at breakfast. I was having breakfast with Wim of MTN just this morning, and we were decrying the cost of KYC. And because on the telecom side he's answering to the UCC, on the banking side answering to Bank of Uganda, the question was, if he has done KYC once, and it's a proper record, you have a national ID, you have a fingerprint, why must the bank do it? Why can we not create a framework where this information can be shared? Because we cannot, on one hand, and I'm so glad the regulator is here, and other regulators as well, we cannot on one hand say, which is a fact, that the cost of financial intermediation must come down, and then not create an environment where that comes down. The direct cost of, the same is true for, so the second challenge that the industry faces is the regulatory framework. It needs to work. It needs to lend itself to the broader national problems for us to make it work. So that's a second part that really, really is key to some of the fourth industrial revolution. And I'll give you another example as well. if we sit here and agree that as an economy, we will do better with less cash as a form of payment, the regulatory environment must follow and really demonstrate. And we want to thank you, Bank of Uganda, that the check cap has come down to 10, but it should be down to 0, because we have seen environments that end up without any paper checks and they're working fine. So creating that, the fuel that we need to drive the change that we need to then transform not just the industry but as a country must be fully regulated and worked through in the same regard. The third is education and consumer protection. So you educate your customers so that they know what is going on, but you also educate them so that they know their rights and they can protect themselves. And that is an ongoing concern, that with every new innovation, you have to carry your customers along, and you have to carry your consumers along. And remember, we said, at the core of all this, any innovation in the world that is not inclusive of everybody, that does not touch as many people as possible, is not innovation, because then it doesn't become sustainable. Any success that is only serving a small part of the society is not sustainable success. So if we change our definition for what we want the sector to be, we then change our expectation of what we want to get from fourth industrial revolution. And you will note that I'm not restricting my arguments to payments. This is cutting across the entire financial spectrum. That if we say that inclusion is at the core, then everything we're doing must be driving that inclusion. And therefore, what we are solving for, from a risk or challenge point of view, must be towards enabling that. We talk about matters like privacy and data privacy, and what that means and where we're going with that. With every single advancement, data privacy becomes a real concern. A real concern. Because now, think about it, and I always like giving examples you can use. If you've been in lockdown for the last 40 odd days, if someone were to get information of how you're spending, be it on your mobile money or your account or even your digital footprint, they know everything you've done. They know where you bought your food. They know where they know everything you've done. So this information, many a time, the fear of this fourth industrial revolution and what it brings is because, what do people know about me? No, I would rather use my cash. Because if I come into the system, then they'll know. So how do we protect that? How do we give people that comfort that even with these new technologies, they will still be protected? Because remember, banking was built on trust.
Yes.
At the core of banking is trust.
Yes.
If we're innovating in areas or ways that are bringing fear as opposed to trust, that becomes a challenge to how we can absorb these systems. And last but not least, I cannot overemphasize the impact on the human element. The fourth industrial revolution, unlike other industries, if you take from the first revolution, which was the steam engine, to the second, which was electricity, the third, which is then computer, and here the fuel is information. It's either machine to machine, machine to person, but it's information at the core of that. And how we as human beings interact with machines to create that magic, right? So the human element in everything we're doing, whether it's skills, whether it's acceptability, whether it's the fears that we have, the human element is such a big part of what we have to solution for, be it from a risk point of view or a reward point of view. The human piece is such a big part of what we need to do.
Thank you. Thank you very much, Anne, and I see the passion that you're sharing with us, and that's very comforting for us as financial services users and practitioners, and bringing out that convergence of the human element of from a user, but also operating point of view to bringing it to life as an important element that we must care about. And indeed, caring it is. We would like to call upon you, Ali, to share with us what kind of interventions can be put in place to respond to at least, not everything, but just one element as we put this to a close. We have a number of people who are giving us questions. Thank you very much, audience, for keeping us engaged. We'll be coming to the questions shortly. Ali, keep it short so that we can get to the questions and respond to the audience. Thank you very much. Ali.
Definitely. Definitely. Thank you. This has been really invigorating, and I'm so excited. Look, let me draw a picture for the audience. So if we imagine a triangle, yeah, and let's imagine that one side of that triangle is man versus nature. And when I say man versus nature, we're talking about, you know, the rising levels of water, the warming up of oceans, the melting of the ice caps, and COVID in itself is a challenge of tremendous proportions. If you look at the other side of it, which is financial and social inclusion, you know, so that is a key part of what we've been discussing. Any innovation, like Anne said, spot on, is not sustainable if it does not cater for social and financial inclusion. And remember, this social and financial inclusion could be led by, you know, gender. It could be led by race. There are many facets to it, and we have to do a better job than what we've done thus far. Now, at the base of this triangle, as how I look at it, is that there's this sense of short-termism. There's this sense of commercial focus, and everything else can follow later. And that no longer is viable. That is no longer sustainable. Short-termism, when I say short-termism, I mean that if we set ourselves quarter-to-quarter commercial goals, that is going to be a grave injustice to doing the right thing for ourselves and our future generations. We must have a 3 to 4 or 5 year plan which caters for, yes, the commercial angle, which is a very important one, but then how are we balancing the man versus nature part? How are we getting the social and financial inclusion in play? And how do we do that? And at MasterCard, you know, we believe in something that our chairman, you know, stresses a lot, is doing well by doing good. And there are a few commitments that come on the back of that. And one of them is that, you know, we will be including 1 billion people into the formal economy by 2025. We set ourselves a goal to have 500 million by 2020, which is done, tick. But now it's another 500 million by 2025. And that's not just as a big number. We have broken it down to 50 million SMEs, and obviously a special focus on 25 million women entrepreneurs as well. So inclusion is a big part of what MasterCard, the way we are approaching the bigger problem across the globe. And, you know, let's look at the current situation, Juliet, and I'll just keep this short. If we, from today, where we are, vaccination levels are slowly coming in, you know, the vaccinations are coming in, or vaccines are coming into Africa. You know, if we are to return back to the pre-COVID growth rates of 5 to 8% in East Africa, we must together, collectively, collaboratively, strengthen the SME sector now, so that once the economy is ready for that boom and there's that pent-up demand that is staring at us, we don't leave the SMEs behind. We need to have the SME sector vibrantly contributing, because if we think that you know, we can solve for this problem later, they may not be a later, because we know that 90% of business contribution to any economy is by the SMEs. So we must uplift them and bring them along. Last example from my side is, you know, it's as simple as an API. We've got a concept called Simplify Commerce that MasterCard has actively engaged in different markets. It's simply an API-based application where an SME can be onboarded in 10 minutes, literally 10 minutes, to start accepting digital payments. It's in a box, it's a template. You can just put up your store, you can sell your goods, and it's very easy. It puts them on the digital map. It makes the lenders happy because now you have data flow, again, versus cash when there is no records. So, you know, it creates a new ecosystem. And it's this kind of ecosystem which can be sustainable and can lead to equitable growth. Thank you, Julian.
Ali, thank you for sharing that. The kind of interventions that industry and other market players can come together to respond to the issues that we have at hand. So we'll take a few questions. And I would like to start with you, Peter Kaumi. And this is from Robert Magala. It says, as we discuss collaboration with fintech players and banks, largely small players with limited governance structures, how do you think the counterparty risk shall be mitigated? Peter?
Okay, thank you very much, Juliet, and great question from you, Robert. My assumption is that Robert's question is coming from the appreciation that there are different types, different sizes of fintechs. And when I say sizes, I mean, we have the startups who have excellent ideas. They've been in business just a few months, to the multinationals like Ali's team with MasterCard and others. The reality is the strength, the capacity of these fintechs is just as vast. And this is even put in even more focus because of the recent passing of the regulations, the NPS regulations that these fintechs now have to comply by. And quite frankly, the reality is that many of these fintechs are now starting to really appreciate the breadth of these regulations and what it's going to take to comply by them. Because of all this, there are different governance structures within different fintechs. Some are very complex, like the multinationals will have governance structures and will therefore comply with the regulations quite easily. Others are almost non-existent, and I think this is the point that Robert is trying to make. What would we do for those small fintechs, those local fintechs that may not necessarily have full compliance teams, full risk management frameworks, and may not therefore understand what it takes, not just to comply with the regulation, but also to serve customers within a safe environment. The association has embarked on a program that we call the Code of Conduct. And what we are rolling out is a framework that allows different players within our membership base to get prepared for a stronger regulatory framework. Of course, this is very much aligned to the National Payment Systems regulations. Some of our members are starting to comply with this Code of Conduct. And I must mention that it was supported, its development was supported by Financial Sector Deepening Uganda. So some of our members have started to comply with this Code of Conduct. What we have seen is that the ones that are complying are actually finding it significantly easier to comply with the regulations when they go to do so. Now, does this mean that the governance structures, the counterparty risk is fully addressed? Maybe not in the short term. However, does it mean that we are well on the way to making sure that these risks and these structures are being adequately addressed? Absolutely. Thank you very much, Juliet.
Thank you very much, Peter. And I believe that even with the current and payments regulations also brings a lot of structure around that, and thanks to the regulator. And I have a number of questions to you, Dr. from the audience, and thank you, audience, for keeping us engaged. I'll give you two questions at the same time, kind of related but different. So we have Robert Tumwine, who says, in this fourth industrial revolution, what is the regulator's plan as far as enabling cloud hosting services for the financial institutions, given that storage is going to be key in this era? And this relates very well with one of the issues that was raised about data. It is one, to collect the data, use and analyze, but then to store it. So I'm very sure you'll be able to respond to that. And the second one related to that is that there are a number of various high-cost unbundled components. There are a number of various high-cost unbundled components relating to the fourth industrial revolution and provided by private players. How shall pricing to the ultimate user be regulated? So it's an issue of pricing. I'll read it again, Doctor. There are a number of various high-cost unbundled components related to the fourth industrial revolution and provided by private players. How shall pricing to the ultimate user be regulated? Doctor.
I'll start with Mr. Tumwine's question. What's our plan for cloud computing? I believe if Mr. Tumwine was with us right from the beginning, I'll just reiterate what I said earlier on, but in a slightly different way. The regulator's role with regards to cloud computing, which is a service, is that we're going to focus on three parts. One, for any institution that chooses to go down the road or have a plan of adopting cloud computing in its services or in its operations, there are going to be three very simple questions we're going to ask if it's a financial institution. One, how comprehensive is your risk register? In other words, how comprehensively have you assessed the risks that you will face today when you adopt it and the risks that you will be facing down the road after you adopt it? Question number one. So the comprehensiveness of your risk register. Two, what kind of risk management mechanisms, frameworks, policies, or tools have you put in place to manage and ameliorate the impact of those risks in the event they materialize? Three, and this is specific to financial institutions, within your capital planning and capital allocation, how much capital are you setting aside to deal with an event, with a situation where one of those risks that you have properly identified, put in place a risk management mechanism for? How much capital are you holding or should you be holding in the event that risk materializes in such a manner that it does not affect your ability to continue providing business tomorrow? That is the broad spectrum. Of course, within the risk identification, there's a whole spectrum of risks. Operational resilience, cybersecurity, like Anne was saying. You have got things like, especially for cloud computing, concentration risk. What does it mean to you, for example, as an entity, if one cloud service provider is handling 80% of your back office operations? How are you dealing with that concentration risk? There's an issue of vendor lock-in. How easy is it for you that if you're dissatisfied with Amazon Web Services for you to move to Microsoft Azure? Okay? There are risks rated around the something that Ali mentioned, the right to be forgotten. When you decide to change a service provider, what guarantees do you have that when you say, I have deleted my data, it is actually deleted? And then, of course, even from a regulator's point of view, is if you have access to your data and your transactional data within the cloud, to what extent shall we also have the same access, or will you give us access through you for purposes of supervision or regulation? That's on the risk identification side. So what are you putting in place to make sure all those are there? I mean, someone might say, oh, well, you see, I have very stringent service level agreements. Okay. But should a risk materialize, is the service level agreement adequate to protect you or to protect the customers whose data you're holding? And the other emerging risk, especially with cloud computing, is that we know that open banking is around the corner. The concept that the customer owns the information and the customer's historical data, which was a competitive advantage for the service provider, now has to be permissioned. Permissioned in the sense that for anyone, that customer, he or she, can make that information available to any other service provider, even irrespective of the fact that the financial institution that holds their data was using that as a competitive advantage. And the other person doesn't have to pay a single shilling or dollar for it. What does that mean for your business model? What does it mean if it's positioned in the cloud as opposed to here? Fortunately, when you look at the Data Privacy and Protection Act that we have in Uganda 2019, I can't remember the section off my head, it was largely an adaptation of the privacy regulation in the EU. Okay? So there are certain inherent protections, and for example, one of the things, if you're going to do cloud computing, one of the questions will be, so where will your data be resident? What are the data residency or data domiciling requirements or risks? The current law that we have in Uganda actually allows you to have your data domiciled elsewhere on the condition that that domicile has got regulations and protections that are equal to or greater than those provided here. So when Mr. Tumwine asks, what are we doing about cloud computing? Again, it goes back to what I said earlier on, that even we as regulators need to first refocus ourselves and decide that we are going to stay away from cloud computing as a technology and focus on the service that cloud computing basically provides, which, by the way, is not actually storage. What cloud computing does, or what a cloud service provider provides to you, is security. Security of your data, security of your processes, and security of the information that's available or that you have or that which they host on your behalf. So the summary of a response to Tumwine is, we are adjusting our regulatory and supervisory focus on two just services and from a risk-based perspective. Second question, that the unbundled high-cost components provided by private providers, how do we address the pricing to the final user? You know, I have my personal discomfort with any attempt at price regulation, and for good reason. You can only attempt price regulation when you have done a comprehensive study or assessment of someone's cost structure. So there are all these fancy models in economics, long-run incremental costing plus and long-run incremental costing 2, to help you understand how an entity arrives at its pricing. And even then, if there are inherent structural inefficiencies in your market, you must price that as a regulator. Isn't the private sector player better able to do that? Shouldn't the focus then instead be on more of conduct issues? Are your practices anti-competitive? Are you deliberately frustrating others from entering the market? Okay? So you can manage price regulation not directly, but looking at conduct issues. Okay? Yeah. So to address the final, pricing to the final user, I don't think that's the place of the regulator. Because more often than not, and I know the governor has mentioned this sometime in 2020 when when the governor issued a statement with regards to directing banks to reconsider their pricing. But at the same time, we'll be the first people to admit that there are certain inherent inefficiencies and structural problems within our economy that keep that pricing high. Let's take the cost of credit, for example, which is the price of money. Okay? Take this opportunity to try and explain something to those who are